Welcome back to another deep dive. We're really thrilled to have you here with us today.
Yeah, pulling up a chair right at the table with us.
Exactly. You are the essential third person in the room today because, well, we are stepping into a highly specific and frankly fiercely competitive virtual arena.
It's a fascinating one, too.
Oh, absolutely. We've got this massive stack of performance reports, financial statements, operational matrices, and it is all covering the BA 427 Winter 2026 business strategy game.
Specifically, we're looking at the postmortem for Industry 43.
Right. Okay, let's unpack this. What we're looking at is essentially a highly detailed, completely simulated corporate battlefield.
Yeah, a closed-loop environment.
Exactly. And the mission for today's deep dive is to figure out exactly why some companies achieve absolute market dominance while others they completely collapse under their own weight.
They really do. It is not pretty.
No, it's not. We aren't just looking at the scoreboard here. We are reverse engineering the mechanics of these simulated wins and losses to give you, the listener, a shortcut to mastering real-world business strategy.
It is great to be diving into this data with you. What's fascinating here is the sheer dramatic separation in the results.
It's wild.
We are looking at this environment with 9 distinct companies, right, competing head-to-head over several simulated years.
Right.
Usually in these tightly controlled models, you expect a neat, evenly spaced ranking.
Like a normal distribution.
Exactly. A gentle bell curve of performance where the margins of victory are razor thin. But that is not at all what materialized in Industry 43.
Not even close.
The simulation created a massive, unbridgeable chasm.
Yeah.
We have 2 absolute titans at the top who cracked the algorithm, and then we have the rest of the pack trailing so far behind.
They might as well have been playing a different game entirely.
Precisely.
And to give you a sense of the baseline here, the playing field these companies started on the industry as a whole actually utilized the exact same toolkit.
Everybody started equal.
Right. They all poured capital into their product quality, which is known in the simulation as SQ ratings.
Yeah.
They all had access to the internet and wholesale channels. They all leveraged search engine marketing, brand advertising, retail support.
That's standard levers.
All of them. But as you're about to see, turning those levers and actually understanding how they interact mathematically, those are 2 completely different things.
Vastly different.
Everyone had the same starting capital and the exact same factory parameters. But the variance in return on equity and earnings per share by the final round is staggering.
The overarching industry report explicitly points out this dynamic. The massive performance gap between the top tier and the rest of the pack was largely driven by a fundamental misunderstanding of operational efficiency.
Okay, break that down for us.
Well, many of the lower performing firms treated marketing and operations as isolated silos.
Like they didn't talk to each other.
Exactly. They assumed a high marketing budget would just automatically translate to high market share.
Which makes sense on paper, maybe.
On paper, sure. But in this simulation, spending without underlying structural support is fatal. It was a market characterized by constant reactive strategy adjustments from the lower performers.
Just panicking.
Yeah, contrasted against the ruthless, long-term strategic positioning of the leaders.
Well, let's get right into those leaders, the titans of Industry 43. Sitting at rank 1 is A company.
Finishing with a dominant score of 111.
111. They delivered the strongest financial results across the board. We are looking at maxed out investor expectation scores.
Which is incredibly hard to do.
It means they generated an earnings per share and a return on equity that completely eclipsed the industry average. Their stock price performance was in a completely different stratosphere.
Unrivaled.
But looking at their inputs, they weren't necessarily the cheapest shoe on the market.
No, they weren't.
Nor were they the most expensive.
Right. A company did not rely on extremes. They utilized what the simulation classifies as a balanced differentiation strategy. But the term balanced can be deceptive here. It doesn't mean they compromised. It means they achieved absolute alignment across every single operational matrix.
Okay, so let's look at the mechanics of how they actually achieved that 111 score.
They heavily emphasized total quality management and Six Sigma training very early in the simulation.
TQM and Six Sigma.
Yes. By doing that, they systematically drove down their reject rates on the factory floor.
But wait, investing heavily in TQM and best practices training, that requires a massive upfront capital expenditure.
It does. It's expensive.
So how did they keep their EPS so high if they were sinking millions into factory upgrades and worker training while still trying to maintain competitive pricing.
Because they understood the long-term math of the experience curve. That upfront capital expenditure in TQM eventually lowers the cost per pair produced.
Right.
Once their reject rates plummeted, their material waste dropped. They could offer a highly competitive ESQ rating without the bloated production costs that plagued the rest of the industry. Their marketing investments were then highly targeted to match exactly what their production lines could handle.
So they didn't overpromise.
They didn't overpromise in their brand advertising, and more importantly, they optimized their distribution capacity across regions, like North America and the Asia Pacific.
To perfectly match their projected demand.
Exactly, entirely avoiding the massive tariff penalties and shipping costs that just destroyed the margins of the bottom-tier companies.
So they basically built a highly tuned engine where the factory output perfectly funded the marketing and the marketing perfectly matched the factory capacity.
It was a beautiful loop.
But they did have serious competition. Breathing right down a company's neck at rank 2 was Gravitate.
Pulling in a massive score of 105.
Gravitate achieved incredibly strong financials too, but they took a totally different route.
It did.
They went with a premium differentiation strategy.
Gravitate is a masterclass in how to execute a premium positioning strategy without pricing yourself out of the market entirely.
Because when you go premium, you are inherently shrinking your potential customer base, right?
Inherently. To maintain high EPS and ROE with a smaller volume of sales, your margins have to be absolutely pristine.
Looking at Gravitate's data, they pushed their SEXQ ratings to the absolute top of the industry.
Top-tier quality.
They used superior materials and likely offered a slightly lower model count to keep their plant setup costs manageable. But what really jumps out to me is their marketing spend.
It was huge.
It wasn't just higher, it was deployed differently.
Precisely. If you were charging a premium price, a standard search engine marketing campaign just isn't enough to convert a buyer.
Right, a banner ad won't sell a luxury shoe.
Gravitate recognized this. They heavily leveraged celebrity endorsements and massive retail support. They needed to engineer prestige.
Prestige is expensive.
It is. But here is the critical takeaway. Their marketing didn't just make noise. It was a mirror reflecting their actual operational reality.
Meaning the shoe actually lived up to the hype?
Yes. When you claim to be a premium brand, your operations have to deliver a flawless product. If Gravitate had spent millions on celebrity endorsements, but failed to invest in their plant's production quality.
The simulations algorithm would have severely penalized their brand appeal.
Exactly. A company in Gravitate proved that whether you choose balanced differentiation or premium differentiation, the actual strategy matters far less than the ruthless consistency of its execution.
Here's where it gets really interesting. Look at the massive point drop from Gravitate at 105 to the very next tier of companies.
It's a cliff.
We are talking about a 23-point free fall before we hit rank 3. That isn't just a gap. That is a totally different tier of competency.
It is a stark mathematical visualization of what happens when strategy becomes diluted.
Yeah.
That 23-point drop separates the visionary leaders from the companies that were essentially just keeping the lights on.
Sitting at rank 3 is Bold Bolts with a score of 82. Now, relatively speaking, they survived.
They stayed afloat.
But they were left completely in the dust by A Company and Gravitate. The report notes they followed a moderate differentiation strategy.
Not moderate.
Yeah. They had decent plant capacity, they spent a respectable amount on marketing, and their SKU ratings were average. But looking at the numbers, being average across the board seems to be exactly what capped their growth.
Bold Bolts fell into the classic stuck-in-the-middle trap.
Right.
In competitive strategy, moderation is often a death sentence. By trying to appeal to everyone, you appeal to no one.
They didn't have the high SKU and prestige of Gravitate to justify a high price.
Yep.
And they didn't have the hyper-efficient, low-cost production machine of A Company to compete on volume and price.
Therefore, their marketing spend yielded a much lower return on investment. They were likely buying search engine clicks, but when the consumer arrived at their virtual storefront,
there was no compelling value proposition to force the conversion.
Exactly.
And if they aren't getting those conversions, they are left with unutilized plant capacity. And in this simulation, unused capacity is a financial anchor.
Exactly. If you build a massive facility in Latin America or Euro-Africa, and you only utilize 65% of its capacity because your moderate strategy failed to generate demand,
you are still paying for it.
You are still paying the depreciation, the maintenance, and the fixed overhead on that entire plant.
Ouch.
That idle capacity eats your margin, which tanks your EPS, which crushes your stock price.
perfectly explains the next two companies as well. We have Excellent Shoes at rank 4 with a score of 80 and Frontrunner at rank 5 with a score of 77.
To cautious players.
The report calls Excellent Shoes steady but conservative and notes that Frontrunner's balanced strategy entirely lacked a clear competitive edge. I look at this and I initially think in a highly volatile market, playing it safe and protecting your cash flow is a smart move.
Let's push back on that for a second.
Okay.
In a static environment, protecting your cash flow is fine. But Industry 43 is a zero-sum, dynamically expanding market.
Right.
Every percentage of market share Excellent Shoes and Frontrunner failed to capture was actively consumed by a company and Gravitate.
They just gobbled it up.
Playing it safe in strategy often just guarantees mediocrity. Excellent Shoes and Frontrunner avoided taking out massive emergency loans, yes. But by lacking a clear competitive edge, they capped their own potential.
They didn't invest heavily enough in plant upgrades to lower long-term costs.
And they didn't push their CSTU ratings high enough to command a premium.
It's the opportunity cost of conservatism. They survived the simulation, but they didn't command investor expectations or drive best-in-industry measures because they simply didn't take a definitive stance.
They just floated.
Which brings us to the bottom tier of Industry 43. This is the anatomy of failure.
It gets grim here.
Let's look at rank 6, Cosmic Gear. Coming in with a score of 67, their operational efficiency was remarkably weak, leading to bloated costs and a total collapse in profitability.
Cosmic Gear is exhibiting the first major symptom of a corporate death spiral.
Which is?
A fundamental disconnect between production costs and pricing strategy. If your base wages are too low, your worker productivity drops and your reject rates spike.
Meaning you are throwing away a lot of shoes.
Suddenly, your true cost to produce a single pair of shoes is $5 or $6 higher than A companies.
Wow.
If you then try to maintain a competitive market price to keep your sales volume up, your margin completely evaporates.
And from the looks of it, Cosmic Gear recognized their sales were dropping, so they tried to market their way out of it.
A classic mistake.
The report specifically notes their marketing activities weren't aligned with their product positioning. They were spending capital they didn't have on-brand advertising, trying to drive traffic to a product that inherently lacked profitability.
Which just accelerates the decline. You cannot outmarket a fundamentally broken cost structure.
It just doesn't work.
If you lose money on every pair of shoes you sell because your factory operations are inefficient, driving more volume through advertising just means you are scaling your losses faster.
And that scaling of losses becomes painfully obvious with the bottom three.
The final tier.
We have H Company at rank 7 with a score of 65. D Company at rank 8 with a score of 62. And finally, dead last, rank 9, I Company with a score of 60, the lowest performance in the entire industry.
Looking at their round-over-round data, these companies were practically in a state of constant panic.
Just flailing.
If we connect this to the bigger picture, synthesizing the fatal flaws of H, D, and I take, companies reveals a distinct, highly destructive pattern.
Which is?
They all suffered from a profound lack of strategic direction, which manifested as what we call strategy drift.
Let's break down that strategy drift, because I think it's one of the most vital takeaways here for you listening. You led at I Company's decisions from year 11 to year 14.
It's a roller coaster.
One round, they are slashing prices and offering 500 different shoe models, trying to be a cost leader.
Then the very next round, they realize their setup costs for 500 models are destroying their margins.
So they suddenly drop to 50 models, hike their prices, and try to pivot to a premium model.
And the simulation severely punishes that exact behavior. Building a brand reputation takes cumulative effort over multiple years.
You can't just buy it in one round.
When I Company pivoted from cost leader to premium overnight, they threw away all the brand equity they had built. Furthermore, there's the sunk cost fallacy in their operational investments.
How so?
If you build a massive factory infrastructure designed for high-volume, low-cost production, you cannot simply flip a switch and turn it into a boutique facility producing high-end SKU premium footwear.
The equipment, the worker training, the supply chain contracts.
They're all misaligned.
It's like trying to turn a massive cargo ship like a jet ski. It just capsizes.
Perfect analogy.
And this ties directly into how these bottom firms handled their marketing, which looks exactly like a leaky bucket.
A very expensive leaky bucket.
When I Company or D Company saw their market share dropping, their immediate knee-jerk reaction was to drastically increase their search engine marketing and brand advertising budgets.
But they didn't raise their CQ rating.
And they didn't fix their delivery times.
Mathematically, It is impossible to recover your margin when your marketing spend outpaces your operational efficiency metrics.
So it's just wasted money.
When D company threw money at ads without fixing their core product, that additional spending failed to generate any sustainable returns.
Because the customer clicks the ad,
Sees a 3.5 SQ rating priced identically to a company's 6.0 SQ ratings.
and immediately bounces.
The conversion rate drops, but the marketing expenditure remains, completely draining their cash reserves.
Which eventually forces them into taking out emergency loans just to keep the factories running. And the interest rates on those loans are the final nail in the coffin for their earnings per share.
It's a vicious cycle.
So what does this all mean? When we look at the chasm between the 1 in 11 score of A company and the 60 score of I company, the overwhelming conclusion is that growth without value is a massive trap.
That is the defining insight. The bottom three companies chased after revenue growth, hoping that sheer volume would eventually save them.
They just wanted to move units.
But the leaders, A company and Gravitate, understood that revenue growth must be strictly accompanied by profitability. They managed for financial discipline.
Not just a top-line number.
Right. They constantly monitored how their plant capacity utilization, their tariff costs, and their shipping fees impacted their return on equity. Investor-oriented metrics ultimately determine whether a strategy is actually working, not just top-line revenue.
And that requires a level of strategic integration that the bottom tier completely failed to grasp. You cannot treat your company like a collection of isolated departments.
Operations can't ignore marketing.
Right. The decisions you make regarding base wages and incentive pay on the factory floor directly impact your reject rates. Those reject rates dictate your true cost per pair.
And your cost per pair dictates the flexibility of your pricing strategy.
Which ultimately dictates the promises you can actually afford to make in your marketing campaigns. It is one unbroken chain.
Yeah.
Exactly. Efficient operations and careful capacity planning are what actually fund competitive marketing. A company could afford to dominate the marketing channels precisely because their production costs were so tightly controlled.
Because of the TQM we talked about earlier.
Right. They leveraged Option B and Option C plant upgrades early on to reduce labor costs over the long term. That operational foresight generated the excess capital they needed to outmarket D&I companies without resorting to debt.
Strategy is coordination.
Strategy is coordination.
So bringing this all back to you, the listener, we promised you a shortcut to mastering strategy, and the data from Industry 43 spells it out clearly. Real success requires absolute alignment.
You have to pick a definitive competitive position.
If you are going for cost leadership, your entire supply chain and plant capacity must be relentlessly optimized for volume and efficiency.
And if you are going for premium differentiation like Gravitate, you have to be willing to sacrifice broader market share to ruthlessly protect your margins and your brand prestige. You pick your lane, and you ensure that every single capital expenditure, every operational process, and every marketing dollar reinforces that specific goal.
This raises an important question, though.
Oh.
The simulation explicitly proves that strategy drift is a fatal error, and that absolute, unwavering consistency is what wins the algorithm. The mathematical data from Industry 43 is undeniable on that front.
Okay, yes.
But in the chaotic real world, where technology, supply chain logistics, and consumer behaviors can shift overnight, at what point does strategic consistency turn into fatal stubbornness?
That is a tough one.
If you lock into a strategy, how do you know the exact moment when you should stay the course and trust your long-term vision versus when the market has fundamentally changed and you actually need to pivot to survive?
That is the ultimate tension in strategy, isn't it? Knowing the difference between a temporary market fluctuation and a permanent paradigm shift.
It's the hardest thing for any executive to parse.
The simulation provides a perfect laboratory to understand the mechanics of alignment, but the real world requires a level of intuition that no algorithm can fully capture.
It really does.
We will leave you with that lingering puzzle to explore on your own. Thank you for joining us for this deep dive into the business strategy game. Keep analyzing the data, keep seeking that operational alignment, and we will catch you on the next one.